In this video clip, we're still busy with question 1811, one of the tutorial questions, and we're now going to look at step 2 of the NCI calculations. So for the step 2, we are concerned since the acquisition date, so when the investment was made in the subsidiary and the subsidiary became part of a bigger group, until the beginning of the current financial year, what changes occurred in the equity of the subsidiary? So if we take the equity of the subsidiary on acquisition date, and that would include perhaps retained earnings and share capital, maybe general reserve, and we then see at the end of the previous financial year what changes occurred between the acquisition date until the end of the financial year. And now there might be, apart from retained earnings, and share capital and general reserve, there might also now be an asset revaluation reserve. And of course, the subsidiary is entitled to part of, the NCIs are entitled to a portion of that. Also, on acquisition date, there would have been a BCVR reserve created, so we have to consider whether any of the consolidation entries that we pass over this period affects these balances, maybe the share capital and so forth. So we're not concerned whether these consolidation adjustments affects pre or post acquisition equity from the NCI's point of view. We just concerned whether they occurred in this this period since acquisition date until the beginning of the current financial year. And if it occurred at any stage here, it's going to be included in step 2 of our NCI calculation. So for this question, we then have to look at the period from the 1st of July 2008 until 30 June 2012. We're busy with the consolidation worksheet entries for 2013. So the equity balances that changed since the acquisition date was retained earnings, a new asset revaluation surplus, and adjustments that we've made to the BCVR. So if we look at retained earnings, we first of all have to calculate the profit that was reported by the subsidiary over that period. So we've got our opening retained earnings, and we know what our retained earnings was on acquisition date. So the difference between those two balances represents the profit or earnings that was made by the subsidiary over that total, spanning that total time. Then we have to look back at our BCVR entries, because our BCVR entries are entries that are passed on top of the accounting records of the underlying entities. Any changes or any adjustments made in those entries that affects our earnings figure will have an effect on our retained earnings reported by the group. So we would have seen that with regards to this period, so remember now that it's before the current financial year, we passed adjustments for extra depreciation of $5,600, and that would be the after-tax depreciation for the 4 years since acquisition date until the end of the previous financial year. And that is the only additional adjustment that we had to consider. Once we've calculated the result of this calculation, we then extract 25% of that and allocate it to the NCI. So we take it from the retained earnings line item, and it's not eliminated from the group results, but it's disclosed separately as NCIs because it's attributable to the other shareholders. The following adjustment is for asset revaluation surplus. Now, on acquisition date, there were no asset revaluation surplus, but if you look at the financial information, you'll see that you've now sit with the asset revaluation surplus with an opening balance at the beginning of the current financial year. So that represents the balance at the end of the previous financial year. And because that balance is 2,000, it means that the change since acquisition on that line item was $2,000. So 25% of that is extracted from the asset revaluation surplus and disclosed separately as part of our NCI. The last adjustment relates to the BCVR. And for that, we have to consider the assets that were revalued to fair value on acquisition date, and that included a revaluation for inventory and a devaluation for accounts receivable. Now, both those assets have subsequently been de-recognized, so the effect of that would have been to transfer from BCVR to retained earnings. So that adjustment had to be included or adjusted against our BCVR. So the inventory and the receivables after tax, 25% of that is attributed to the NCIs. Now, both the retained earnings and asset revaluation surplus was an increase in those balances. So therefore, we would expect an increase in the NCI along that lines. The BCVR was actually a decrease in that reserve balance. So the effect of that is a decrease in the NCI. So now you can start to see that the NCI, after you've calculated the basis NCI on acquisition date, the balance of the NCI will just move along with any changes in equity from a group perspective. In the next video clip, I'm going to look at the NCI calculation in step 3, just covering the normal accounting transactions, excluding the intergroup adjustments that are made on consolidation.